Okay, a hush has fallen on the room, so I think it is time to begin. We are a touch early, but at CBS, to be early is to be on time, in my view. And so it is my great pleasure to welcome you to our Spring 2026 Global Markets Update, where we're going to be discussing...
Excuse me, this is springtime?
It is springtime. I'm Canadian, so this feels like a warm day here for me. And that is precisely why we have Abby Joseph Cohen here to speak with you, because settled norms, proxims, consensus is not what we're going to be speaking to, but instead poking through some of the settled rhetoric on where the economy is, where it is going, and what the key drivers of those are going to be, and how markets relate to those fundamental developments. My name is Brett House. Unlike Abby, I am only an emerging icon rather than a full status icon here at CBS. I'm a faculty member in the economics division, and I serve as a senior scholar with the Chazen Institute for Global Business, which is sponsoring this event today. So our thanks to the Chazen staff and leadership for convening this conversation. It is also being co-sponsored by Columbia Women in Business in view of the pathbreaker we have speaking with us this afternoon. For J-termers who have just joined us, a particular welcome and a bit of context. The Chazen Institute is the hub for global business activities here at CBS. It was founded in 1981 at a time when the global business landscape, the existence of cell phones and the internet were still twinkles in our eyes, when the global business landscape looked very different than it does today. For those doing the math, that means the Institute is now celebrating its 35th anniversary this year. So please be on the lookout for a series of events and celebrations taking place over the next few months, kicking off with this conversation today and tables in Kravis Hall, where Chazen staff will be available throughout today to answer your questions, and there are cupcakes. As I've learned over 3 years at CBS, food is a big motivator here, and the quality of the cupcakes is consonant with the very high level of advice you'll be receiving. Now, it's my honor and privilege to facilitate today's conversation with Abby Joseph Cohen. I mentioned to a few of your classmates that if I had projected forward back in the 90s and the 2000s, when nearly every day there was a headline with Abby's name in it related to markets, if I had projected I would be sitting here having a conversation like this with Abby, I would not have believed it. So it is a true honor and privilege, as I mentioned. Abby has been at the school for about a decade, first as an adjunct professor, and then from 2022 as a professor of business in the economics division. It's a rare treat to have someone of Abby's caliber, stature, and experience with us who is also so enthusiastic about being in the classroom. And really, this is the biggest of our classrooms here at CBS. With students, and so we are very lucky to have you, Abby, and thank you for making time for us. Abby's breadth of knowledge and practical experience gained over 30 years on nearly every major macroeconomic front is unrivaled, and particularly her knowledge of institutional investment and insights on how the investment industry and markets intersect with economic fundamentals is notable. As a school, we get to draw on that knowledge and insight on a regular basis, and it is one of the real delights of being here at CBS. In preparing for our conversation today, I was reminded that Abby's resume is one that runs to some 4 to 5 pages. So let me share just a few of the particular highlights. Abby was a long-serving partner at Goldman Sachs, where she was the firm's chief U.S. investment strategist and was regularly cited as one of the most influential individuals and indeed path-breaking women on Wall Street. It is no overstatement, as I mentioned, to say that she is a true icon, having been celebrated in both Harvard Business School cases and New Yorker cartoons. Abby also headed Goldman's Global Markets Institute, which focuses on the intersection of economics, financial markets, and government policy, much as we'll do today. She led a variety of research projects and firm-wide initiatives across areas such as environment, social and governance issues, immigration, science and technology, labor, capital formation, and innovation. More recently, Abby serves on the board and executive committees of the Brookings Institution and the Jewish Theological Seminary, and is a presidential counselor at Cornell University, where she chairs the steering committee of the Jacobs Innovation Center at Cornell Tech here in the city, and is a life fellow of Weill Cornell Medicine. She is a native New Yorker. As you can hear from my accent, I am not. And she has earned degrees in economics, 3 honorary doctorates, and was awarded the Barnard Medal. Her career has been the subject not just of those profiles I mentioned, but many profiles in major media outlets. Please join me in welcoming Abby Joseph Cohen to our conversation.
Thank you, Jeff. Thank you all.
Now, Abby.
Do we have time left for a conversation?
Oh, absolutely. And I should flag, we are going to kick off with an interactive discussion up here in front. But I would encourage you to start thinking about questions you would like to bring into the conversation today. That is our highest priority. We're really just sort of, warming the room for you to bring your concerns, doubts, queries, and insights forward to share and get Abby's responses. So there will be microphones moving around the room to pick up your questions. And after just a few minutes of conversation here, we will throw it to you to keep the conversation going. So this is the time of the year when Wall Street investment houses, pundits, think tanks, advisors of all kinds are issuing their outlook for the year ahead. In some ways, it's useful to look back at the year we just concluded, where the economy, the real side of the equation, and the financial side in markets sent us some varying, sometimes not always entirely consistent signals. Looking ahead to 2026, how would you close the door and sum up 2025, and then add your view to what we have ahead of us in the year coming?
Okay, that's a good way to start, Brett. And by the way, I'm delighted to see so many people here, and I'm expecting some really good questions, so please think about it. In terms of 2025, it actually turned out to be a somewhat better year than many people had expected, in large part because some of the really foolish policy initiatives that had been discussed early in the year faded away. So we ended up with economic growth that was probably 2.5% to 3%, which was what many people had expected prior to the tariff discussions in April of 2025. Inflation, by the way, was incredibly stubborn. Inflation was quite high, as you may know, in the immediate post-COVID period, but by the end of Mr. Biden's term of office, inflation was down to 2.75%, which, by the way, is where it is right now. So there's not been much change there. The other thing about 2025 is that corporate profits were extremely good. And I think that when you put this all together, it helps explain, in part, why the equity market performed as well as it did. So much has already been written and discussed about the way the equity market was concentrated, that there are certain categories of stocks that performed dramatically better than others. But the truth is that the overall index did pretty well. So what does that mean for a setup for 2026? I'm going to disappoint you, Brett, and say that I think that the consensus outlook right now for the economy and the markets is about right. And when I look at forecasts, I do it on a probabilistic basis. So we all know that nothing has 100% certainty, but when I take a look at what is most likely for 2026, I come up with the conclusion that we'll see economic growth on the order of 2.5%, maybe a little bit better. I don't think inflation is going to be changing very much because I don't really see the mechanisms in place to bring it down. So let's call it 2.75%. The thing that is also very interesting is the outlook for corporate profits. And many people are saying corporate profits are probably going to be shaved a little bit this year. I think that's true, in part because the year-on-year comparisons are much more difficult. And in addition, we are seeing that for many businesses, the cost of business has risen. Some of that is tariff-related, some of it is related to wages and so on. And so I think we're going to see some pressure on profit margins. For me, the interesting thing is always, okay, here's the probabilistic central tendency. I always like to spend my time thinking about the tails. What could go very right and what could go very wrong? And when I think about what could go very right relative to expectations, I'm not coming up with anything. I always start my work looking at the fundamental setup of the economy, corporate profits, and hence valuation. When I look at S&P valuation, basically what is priced in is a pretty attractive scenario. I would rather invest when everybody's really grouchy, and what is priced into the market is a not so happy scenario. But what's priced in right now is a pretty good scenario. And so I don't really see that there's much room for positive surprise. What about the other tail? That's where there's much more to discuss, unfortunately. I think there are a number of things to be concerned about. And by the way, when the market is basically at full valuation, we can discuss bits and pieces more carefully later on if you like. But if we're basically at full valuation, where what's priced in is about as good as it's going to get, you don't have any margin for error. And so if there are disappointments, if there are negative surprises, there is not really a cushion. There's no safety valve. And I think we're in one of those situations right now. So what are the things that I'm looking at? I'm sure everybody here has their own list. There is the infamous, I put this in air quotes, the geopolitical risks. You know what I'm referring to. Erratic trade policy, for example, erratic foreign policy, unfortunately, much of it coming from the United States. And these are things that I find troubling. The other thing that is potentially troubling is whether there are some odd things that happen vis-a-vis government policy. And I'll focus, at least for now, on the United States. Fiscal policy is at full tilt. We are running incredibly high deficits. And what does that mean in terms of the outlook for interest rates? What does that mean in terms of currency, and so on? And although I can give you a list of about 20 things that I'll be monitoring this year, I'm going to stop with the third one, and that has to do with this rush to deregulate. I know the theory that says regulation, too much regulation or inappropriate regulation dampens economic growth. I know that inappropriate regulation can be inflationary. On the other hand, appropriate regulation in a capitalist economy is what gives us sustainable economic growth. And what I am concerned about is what I see as a deregulatory fervor in this administration. We have seen deregulation from the SEC as it relates to crypto. We have already seen deregulation from the Federal Reserve as it relates to oversight of banks. And we are seeing deregulation in a whole host of other categories, including health and safety. I view these as being potentially, I was going to say dangerous. I'm going to be politically sensitive. I am concerned about where some of this could lead. And some of the things that I've not discussed, of course, is what's going on in other countries. And we can get to that later. So let me stop there.
Well, you nicely highlighted the source of volatility we saw through most of 2025, which uncharacteristically was policy. We normally think of monetary and fiscal policy dampening volatility rather than heightening it. How do you see those dangers or concerns you highlighted playing out over the course of this year? Are those near-term concerns? Are there other sources of policy-induced volatility we should be watching for, and what are the likely implications?
Okay, so let me go back to the potential impact of deregulation. One of the things that some of you may not have the same sensitivity to that I do, not having lived through the global financial crisis directly as a market participant at that time, is one of the sources of instability prior and during the GFC was inappropriate attention to financial innovation. There were some very significant financial innovations that regulators misjudged and didn't appropriately, in my view, supervise or at least look at. You know, regulation doesn't necessarily have to be, we have this book here and you have to follow it, but it involves, for example, bank supervisors looking at what's going on. And one of the things that was missed, for example, the 3 or 4 years prior to the global financial crisis was this enormous growth in subprime lending. Subprime lending for housing, subprime lending for automobiles, and the willingness of the credit rating agencies to turn a blind eye to it. Basically saying, there's a pool of loans here that are really very bad quality. They are what was referred to as junk, or let's just call them subprime. And there was the sense on the part of financial intermediaries that if you combine this bunch of subprime with that bunch of subprime, instead of averaging out that it's still subprime, they lifted the credit rating on it. Now, why does that matter? Because it meant that banks could lend more money on it. That doesn't mean that the underlying assets were of better quality. They weren't. It just hid the fact. And there were people at the Federal Reserve who were concerned about this as they looked at the subprime housing market and also the subprime lending for autos. And the deregulatory actions taken by the Federal Reserve at that time basically said, let's not worry about it. The staff at the Fed said, you know, it's only 15 to 18% of the total. Even if those are problematic, if they go into default or something like that, the rest of the system is safe. What they missed, again, in their deregulatory fervor, was they were not looking at the leverage that was in the system. The banks that had lent money to these entities that were not as creditworthy as they thought, and then there was just layer upon layer of leverage. Now, why am I belaboring this point? Because I would suggest to you that we may be seeing a similar situation develop right now. And what might it involve? It might involve, for example, crypto and crypto-related instruments. The SEC has stopped regulating in this category. And financial institutions are looking at many of these instruments and saying, okay, this stuff is all right to have on balance sheets. It's all right for financial institutions to have on their own balance sheets. And it's not clear to me that what's being properly assessed is the volatility associated with some of these securities. By the way, I'm not really sure they're securities, but I will stop at that moment. Now, I have just consciously tried to say something very provocative because there is a generational divide right now with regard to this level of financial innovation and this type of financial innovation. All the surveys indicate that people in your age category tend to view what's happening in this area as just fine. I'm not convinced of it. Because when I look at the people who are supposed to be looking at financial innovation and making sure it's being properly recorded and audited and so on, I see that they are not doing what they would have done previously. So whether it's the SEC or whether it's the various banking agencies, I just don't see it. By the way, one of the exceptions is the New York State Division of Financial Services, which, by the way, is the second most important securities regulator in the country. They're looking at it, and they're coming up with concerns in this regard. Now, there are several other aspects of this that I could discuss, but what I'm trying to do is to, again, provoke you, because remember the way Brett set this discussion up, and that is to talk about things that may be out of the consensus and may be things you are not yet thinking about. So I put that down there for you to contemplate, and if somebody wishes to argue with me about it afterwards, I'm very happy to entertain that.
Mm-hmm. Now, the nomination of Kevin Warsh to be the next chair of the Federal Reserve to replace Jerome Powell falls at an interesting time in light of the comments you just made. Warsh has outlined a narrow agenda for the Fed, a shrinking of the number of topics it deals with that complements what Michelle Bowman, current Fed governor, has been doing to shrink the regulatory infrastructure at the Fed. What do you see as the likely implications of a Warsh chair for interest rates, monetary policy, and the work of the Fed as a whole?
Okay, I'm so glad that you presented it as the broad spectrum of what the Federal Reserve is responsible for. It's not just interest rates. And to me right now, quite frankly, the interest rate outlook, particularly for Fed funds, I don't really care. because there's not much that's going to happen. It's going to be 1/4 of a basis point this way or that way. What really matters from my standpoint is what the Fed does on those other two issues. One is the balance sheet of the Fed, and the other is what they do on regulation. Now, what about the balance sheet? I'm going to take pity on all of you. I'm not going to give you a mini lesson on monetary policy.
Though some folks have had it.
Yeah, okay.
Who were in GE in the fall. The J-termers are new to it.
Okay, so for those who would like to have a refresher on this, I would suggest you take a look at Paul Krugman's piece that he put up on Substack this weekend. Paul Krugman, Nobel Prize winner, a professor of economics, did a really nice job of summarizing monetary policy and how it is implemented. And one of the things that he points out that I think many people forget about is that the use of reserves is a critical part of monetary policy. It's not just the short-term interest rate that matters. In fact, the sort of simplistic discussion that we have seen from some people saying we need to shrink the balance sheet regardless of what's going on, harkens back to the general understanding of monetary policy that was common in 1913 or in the early 1920s. Basically, not at all reflective of a modern banking system, because a modern banking system does depend upon reserves, because every bank has reserves which they then multiply in terms of what they are able to lend out to others. If you don't have reserves, there isn't really a banking system, right? You know, the amount of money that goes in is the amount of money that can come out of a bank, and there's no multiplication, if you will. So using reserves, be they reserves at the banks or reserves at the Fed itself, is really quite essential. And one of the concerns I do have about Mr. Warsh is that, at least in his public statements, he has been very tough saying, I don't believe in expanding reserves. Doesn't make terribly much sense to me from a theoretical standpoint. If nothing else, the amount of reserves on the banks, on the Federal Reserve's balance sheet ought to reflect the size of the economy or the growth in the economy. So you can facilitate financial transactions. If you are not providing at least that amount of reserves, that by itself is contractionary. That is a very tight monetary policy, which is probably not what the president had in mind. Now, what about regulation? Michelle Bowman, who is the member of the Board of Governors, who is in charge of regulation, has focused her work almost entirely on loosening regulations on small and mid-sized banks. And the argument is that regulation is often burdensome for small and mid-sized institutions. It may very well be. The concern that I have is whether in the enthusiasm for loosening that regulation, we're also loosening supervision, right? The Fed has both sup and reg. As a former Fed person, it's sup and reg, supervision and regulation. And so you can adjust regulation, but you really shouldn't ease up on the supervision. I'm sure many of you recall the failure at Silicon Valley Bank, which was a failure not just of their internal management, but also of the supervision by banking authorities. And I would be concerned about what happens if we, in fact, don't properly oversee what's happening at banks. By the way, the large banks, the so-called GSIBs, the globally systemic important banks, they know how to take care of themselves, right? They have higher reserves. They have the facility to look at counterparty risk and so on. It's the small and mid-sized banks where you actually have more failures. And that to me is kind of worrisome. I don't think we've seen the end of this puzzle. If you go back to that other potential risk I raised before about stuff on balance sheets of financial services entities that are not being properly valued because we're not looking at the volatility appropriately, small and mid-sized institutions may in fact be much more vulnerable than the larger ones.
Now, let's tie all of that back to markets. Since the Fed started cutting short-term policy rates in September 2024, we haven't seen long-run bond yields come down in lockstep. In fact, if anything, the 30-year yield went up significantly, has remained high over the last year and a half. What does that tell us about markets' read on the fight to control inflation? And where do you see that market view going over the course of this year?
Yeah, that steepening of the yield curve, when we look at the yields on 10-year and 30-year Treasury securities, reflects those inflation expectations, which haven't come down. I mentioned before that actual inflation is running 2 3/4. And by the way, the CPI may be much hotter than that. If I can bore you for a minute or two with some wonky stuff about the CPI, because of the government shutdown, and now we have another government shutdown, and because the Bureau of Labor Statistics has actually seen a reduction in their funding in recent years for things like data collection, we're not collecting the CPI data the way we have done in the past. And this is something that is actually now undercounting inflation. Let me repeat that. We are undercounting and underreporting inflation. Why? Because when the CPI people go out around the country and they actually collect the information about has a price of a certain item or service changed from month to month, they haven't been able to collect all the information. And in the last report, about 60% of the items that should have gone into the CPI calculation could not have been, they were not counted. What did the BLS decide to do? Rhetorical question. I'll answer it for you. They zeroed it out. So 60% of the items couldn't be observed, and so they assumed there was no inflation in them.
Which is distinctly different from its practice in the past, where they would have imputed
That is correct.
price changes with similar products rather than just assume they were flat.
That is correct. So we have a situation where because of underfunding and understaffing the BLS for several years, not just under this administration, and then adding on the current stresses that we're reading about, we are in fact undercounting the CPI.
Goodness.
And so your question is, how come intermediate and long-term interest rates haven't come down? Mm-hmm. There's not a conviction out there that inflation is actually coming down, number one. Number two, there's real concern about the dollar. The dollar has fallen precipitously since the beginning of Mr. Trump's second administration. There's not the same level of confidence in the dollar that there used to be. By the way, I would say that I believed and wrote about in early 2025 that the dollar was overpriced. So it's not just Mr. Trump, but the dollar was probably a little bit too frothy and has come down, but maybe it's come down even more because of some of the erratic policies we've seen as it relates to foreign trade and financial flows.
And if anything, in historical and modeling context, it still remains quite strong.
It depends upon the currency that you're looking at.
Truth. Now, you mentioned, I'm going to circle back to the implications for all of this on other major economies and markets in the world. And one of the real privileges of being at CBS is the really high percentage of our students who are not from the US. And that makes our conversations always more international than they would otherwise be. It's been said in the past that when the US sneezes, the rest of the world catches a cold, whether it's through Fed policy, interest rates, or the dollar. What are the big implications you see of the terrain you've laid out for other big OECD markets, rich industrialized country markets, emerging markets, or frontier lower economy markets? Mm-hmm.
I would add one other factor, and that is that the US consumer has typically been a major source of demand for the global economy. And so it's so important to see what the US consumer is thinking and feeling. I hate to say it, that the confidence level of the US consumer right now is at a multi-year low. People are looking at policy changes, they're looking at an erosion in real wages and so on, and not really feeling so great about the situation. The other thing that they're not feeling so great about, based upon these surveys, is the employment picture. I know that the unemployment rate looks okay, but the unemployment rate, again, wonk alert, the unemployment rate, it's the numerator, the denominator, right? The numerator is the number of people who are unemployed, who are looking for a job, divided by the size of the labor force. We have seen a shrinkage of the labor force. And so all of the numbers are kind of skewed by that. I would rather look at some of the other detail that's provided by a survey called the JOLTS survey that looks at how many new job openings are there and how long have unemployed workers been looking for jobs and so on. And those numbers don't look great at this point. They don't look dreadful, certainly not at recession levels, but they're not as comfortable as one might expect with the reported level of unemployment that we're seeing. So when we talk about the rest of the world, there are some fascinating things to be looking at. Now, I could give you the run of the globe and say, this is what I expect for France, and this is what I expect for Germany, and so on. I don't want to do that unless there's a specific question. I think the important aspect here is that we're seeing that US trade partners are finding other nations with whom to trade. And this is something that started during Mr. Trump's first term. When Trump 1.0 withdrew the United States from something called the Trans-Pacific Partnership, which was a trade agreement between the United States and our trade partners who had coasts on the Pacific. So it included not just nations in East Asia, but also Latin America, Canada as well, Mexico. Basically, that was not a very sensible thing to be doing. It did not include China, by the way. The Trans-Pacific Partnership was designed to be something that would provide some immunization of our smaller trade partner countries against Chinese power. By withdrawing the United States, what we have seen has been a plethora of new regional agreements that have been drawn, including with China. So the United States hurt itself through that withdrawal, and we're seeing more of that as well just over the past year because of, I'm going to use the word again, the erratic nature of the trade policy being followed by the administration 2.0. We have seen, for example, this limited trade pact between China and Canada. We have also seen some introductory trade pacts with the UK and China and so on. And there's so much more to talk about, but I'll mention one other thing. The United States has benefited so much from having the US dollar be the world's reserve currency. And if you've not yet taken that course, you will, and you'll learn much more about that. For many years now, there has been a desire expressed first by the Europeans when they created the Eurodollar, then by the Chinese when they saw the more significant growth in their own economy 20 or 30 years ago, that they wanted to be part of that action, that there was a discussion about having a basket of reserve currencies where the dollar would dominate, but these other currencies would also play a role, perhaps on a trade weight basis. One of the things that we are seeing is that de facto, the world has moved in that general direction. So for example, the Chinese have been insisting that commercial contracts in Asia and elsewhere be denominated in renminbi rather than in US dollars. Now, before all of this, if we go back 10, 12 years, something like 90% of the commercial contracts in Asia were done in US dollars. Only 10% of that was with the United States. All right? We have now seen that number, that 90%, come down substantially as the Chinese are insisting that their regional trade partners in East Asia contract in renminbi, and also commodity contracts, which were always done around the world in the form of US dollars, are also now being done in renminbi. So it makes the Chinese currency more important. And by the way, I'm not a precious metals expert, but I'm sure you've all read the same things that I have, and I also have access to some people who are experts in this category, basically saying that some of the acquisition of gold over the last year has been done by sovereigns, including China, as they are, I don't want to say easing up on their US dollar reserves, but they're rebalancing their reserves, and they're putting more gold into their overall portfolios.
Now, last question before we bring you in, so do start mustering your queries. It'd be remiss if I didn't ask you about AI, given your central role as one of the early folks who identified the impact of the internet on equities and on markets through the 90s and into the early 2000s. How do you think about AI now in terms of both its implications for productivity, for that, as a Canadian, I'll say the heated rivalry between China and the US, and the implication for the job markets that all of our students will be facing?
Yeah, I'm a Washington Capitals fan, in case anybody's interested. Go Ovechkin. With regard to AI, in the interest in full and fair disclosure, I actually head the steering committee of the Innovation Center, the AI Innovation Center for Cornell Tech, which is over in the East River. My undergraduate degrees are in economics and computer science, so I'm a techie. I believe in technology. I set that out there. And so I do believe that AI represents something special, okay? I'm making that statement. However, where are we in terms of what has been invested, what have been the results, and what's likely to happen next. One of the concerns that I always have, just based upon the way I look at markets, is whether there's too much enthusiasm for something at any particular point in time. And one of the issues that I have right now about AI is we're sort of there. You just take a look at the calculations, people looking at earnings reports, looking at shareholder reports that came out last April and so on. The vast majority of companies in the S&P 500 and broader indices as well talked about AI, what they're doing with AI. The surveys, however, of the analysts who follow these companies say they're spending a lot of money, but they're not really reporting out very much value. Now, it may be because it's too soon. We don't really know that. Speaking as a computer junkie, I would tell you that the LLMs that are out there right now, the large language models, are not well suited for the applications that companies say they're using them for. The LLMs that are out there right now were designed for what? Customer service. You know, the dumb question about, you know, I can't get my dishwasher started and what should I do? That's what it's aimed for. It's not artificial intelligence. It is data retrieval, except the data is not digital, it's words, okay? So a lot of what's going into these LLMs is not really useful for artificial intelligence. Where I have much more confidence that something will pan out will be in the privately developed approaches. And you know, I'm not doing this as a certification for anybody, but you know, a Claude model, for example, or an internally developed model, that's where the real productivity benefits seem to be occurring. In Brett's very gracious and warm introduction of me, he also mentioned that I'm on the board of the medical college. And I see that the combination of AI and the medical school has led to some really beneficial applications, but they are very customized. It's not off of the LLMs, for example. So where do I come down? I am concerned about there being a lot of, you know, we used to call it greenwashing when it had to do with ESG. I think there's a lot of AI washing going on right now. So that's number one. Doesn't mean that some of it won't pan out, but we have to be very, very particular about it. Number two, I am concerned about the circular finance that we're seeing among a lot of the participants in this industry, where a chip manufacturer is actually providing all the financing for their customer. And how much demand would there be if not for that? Number three, I'm concerned about the cash flow, not of the major participants. They are generating lots of cash, but I'm concerned about the cash flow and application of cash among some of the smaller participants and users of these items, and basically saying, are they investing sufficiently in other things that they need to do? The other aspect that I am somewhat concerned about is the energy intensiveness of so much of this. You know, we know, for example, about the way data centers are skewing the demand for electricity generation in any number of parts of the country. Not so much in New York. Washington, D.C. has a huge problem. Potomac Electric Power has seen this huge increase in rates. Other parts of the country also seeing huge increases in rates. And I could go on forever and ever on this, but we do want to have questions. So let me just add one more thing. I was invited not that long ago to sit in on a conversation among politicians and leaders in some rural states. Heidi Heitkamp from North Dakota, Chris Sununu from New Hampshire, and some others. And what was interesting to me is they talked about the way there was enthusiasm in their states and in some of the local communities to attract the data centers to their communities. And the public finance that had occurred as a consequence of that. What they basically said is, but these data centers don't have customers yet, and maybe they won't. So the only thing they're really seeing thus far has been an increase in employment because of the construction of the data centers, but no one is looking at the next stage, which is, will there be ongoing demand for this? And the answer is, don't know. If I go back to the crypto question, the energy inefficiency of some of the cryptocurrencies is absolutely staggering to me. And I know that a lot of those facilities can be revamped to be data centers for other, perhaps more useful applications, but there's going to be some friction involved in this. And so I don't think we've seen the end of it. If you're into economic history, you've probably read about the railroads and the way that there were too many railroads built in North America and elsewhere, beginning in the 1840s and 50s and so on. And it wasn't just that there were too many of them, is that they didn't talk to one another. So here's one thought for you. Why were so many of the tracks abandoned? Ultimately, they needed those tracks because there wasn't any coordination. And so depending upon which railroad company it was, the gauges of the tracks were different, which meant that they couldn't connect with one another. And by the way, the undercarriages of the rail cars didn't match. It was an incredible waste of resources. And one of the things I worry about now, if you allow me this historical analogy, which may or may not be correct, but may be more correct than not, is I do worry about whether all of the capacity that is being built now for data centers and other things, whether they in fact will be sufficiently, I'll call it malleable, sufficiently flexible to accommodate whatever the future demand really turns out to be. I'll stop there.
There's a lot to consider in that, and we would like to bring in your questions on any of the topics we've covered so far, or to augment them with things you haven't heard discussed. Up at the far back, please introduce yourself and do keep your question brief so that we can bring in as many of you as possible.
Good afternoon, Professor. My name is Sean, a first-year MBA student. So on top of what you just said, we saw the commodity market collapsing last Friday with some of the precious metal going parabolic for weeks. And we saw the crypto market collapsing over the weekend with Bitcoin trading around 74,000. Yeah. And we talk about the weakening of the dollar as well as the rising 10-year bond yield, both in America and in Japan, which can potentially lead to a yen carry trade unwinding. I think it's fair to say the economic world is kind of chaotic right now, but as we speak, the S&P 500 is attempting another all-time high. So my question is, what do you think are the driving force of the stock market? And do you think the stock market rolling over is going to be sooner or later? Thank you.
You put an awful lot in there, all of it correct, all of it very good observations. So let me try to pull it together as best I can. One topic that I didn't mention, but addresses some of your points, has to do with the gamification of the financial markets. And what do I mean by that? We are seeing that there are participants in the financial markets that are very much driven by momentum rather than by valuation. So why did silver and gold each collapse 10 or 12% in the course of less than an hour at the end of last week? Because they had moved up so dramatically based upon the momentum trade that had existed previously. And when something is based upon the momentum trade, or I'll call it the gamification, because there wasn't really a fundamental argument behind it before, it could very easily reverse. And it could reverse with a great deal of potential damage. I'm not aware that there was damage this time around, but what I am concerned about is what about situations where some of those purchases were done on margin, and there were margin calls. Commodity markets are one thing, equity markets something else. But those are among the concerns I have. I think the prediction markets also add a level of volatility into the financial markets. You know, there's not any regulation for prediction markets. This is something that I find it troubling. I mean, it's one thing if you're betting on the Super Bowl, you know, God bless, or a horse race, or whatever you're doing, or a hockey game. When you start to bet on things where there are true financial market implications, that is something that I find worrisome, particularly since surveys indicate that some of the people who are participating in this way are underage, or don't really have the financial resources to be doing what they're doing. So all of the stuff that brokerage firms need to worry about, know your customer, know that they have the financial resources, know who they are, that they're not, you know, evil players, and so on. None of that exists in the prediction market, which concerns me. Now, your last question had to do with what the stock market is up today. Great, I'm happy that the stock market is up today as well. I think that investors looking around today is saying, okay, the reality TV show having to do with the selection of the next Fed chair is over. We're probably going to have a resolution, and we're not going to have a long-term government shutdown at this time. And people can tick off the various things, including, you know, the last round of corporate profits, by the way, which isn't over, is coming in pretty well. So for those who want to be enthusiastic about the equity market, those are the reasons. And I'm very happy when financial markets perform well. But I would just revert to the point I made earlier, which is, you know, there's this difference between trading short-term versus investment. And typically, investment will follow a combination of the fundamentals and the valuation. And if there are reversals in some of the good news that we're seeing today, there's not the same sort of safety valve that we would normally hope to see.
Okay, right here.
Hi, professors. Thank you so much. I wanted to ask a little bit about the Clarity Act. So the Clarity Act has been on thin ice lately, and my understanding is the CFTC is primarily under-resourced and doesn't do as much for consumer protection. Do you think that if the CFTC becomes the primary regulator for digital commodities, do you think that will provide a potential risk to the U.S. economy? And more broadly speaking, what macro impact do you think that this type of regulation could have on banks who are concerned about competing right now with the profits of some of these crypto companies and stablecoin issuers?
I'm happy to answer. Did you want to get involved?
No, over to you, please.
Okay, so, you know, the regulatory agencies, to me, are quite interesting at this point. Some of them are still well-staffed, but the top layer of the most experienced people have been removed. Some of them were political appointees who you would expect to leave at the beginning of a new administration. Others are just the very senior, experienced civil servants who have been fired. And it's the loss of that group of people that I'm quite concerned about. Now, I'm not going to comment specifically about the CFTC. In the banking agencies writ large, we're still seeing the same numbers of people there. The Fed, for example, has not had wholesale firing the way some of the agencies that are directly under executive control have seen. But I do worry in all of the agencies about what happens at the top. The other thing to keep in mind, and I'm glad you raised it, is the innovative nature of some of these products. And by the way, I'm a big fan of innovation, right? I'm a huge fan of innovation, including in the financial markets. But it requires that the people who are overseeing it and looking at it understand what it is they're looking at and what they should be looking for. And so what I'm concerned about is whether with a narrowing out, a thinning out of the very senior people, experienced people at the top, whether the mid-level and junior people really have the experience and expertise they need to be overseeing these products properly.
Up in the center here at the back.
Hi, thank you so much for sharing your views on the economy with us today. My name is Christine, and I'm a second here at CBS. And so my question for the both of you, I'd be curious for both perspectives, is with a K-shaped economy, do you think that there's real danger that the lower income bracket is spending beyond their means? And do you think that could actually create a ton of risk in the market? Specifically, do you think we will see ripple effects where these all-time high valuations for many assets will fall significantly?
So let me get started, and then Britt can add. The K-shape is a very interesting way to describe it. It's not exactly accurate because the bottom of the K isn't really downward pointing. It's just kind of not pointing up the same dramatic way that the others are. And we do see that upper middle income is doing okay. It's middle income and lower middle income where there are some issues. And I am concerned about it. Taking a look at middle income and lower middle income, what we do see is that more debt has been taken on. And the way the current administration has talked about dealing with it is to basically cap or try to cap the interest rate that is charged on those credit cards. Now, this level of market intervention, to me, is really quite impressive because if a Democratic administration had engaged in this level of market interference, I think there would be howls of complaints from others. You've probably read elsewhere that one of the reasons for high interest rates on credit cards for lower quality credits is to offset the losses that would be in that category. I do believe, based upon what I have read from a variety of the issuers themselves and from economists, is that if you have an artificial cap on that interest rate, let's call it 10%, which is what had been proposed, what will happen is that many of those households that have been relying on credit will no longer have access to the credit, and that will have a negative implication on their consumption pattern. It will be the consumption pattern not just on credit cards, but also consumption with regard to other forms of spending, including autos and so on. So I am concerned about what that might mean for those households and ultimately for the economy writ large. The interesting thing, of course, as I mentioned at the outset, is upper middle income and above are doing quite well. So you may not see the problem in the aggregate consumption data, right? You may not see the problem in aggregate spending in various categories, but you will see the impact on these individuals, and these are also the individuals who are seeing the problems with regard to their own employment. Wages that had been moving higher in this category have stopped moving higher. I don't know if that's a temporary phenomenon or not, but certainly something that bears watching.
And I'll build on Abby's comments by noting in global economic environment, our core macro course, we spend some time disaggregating and dissecting data like the consumption numbers Abby mentioned. And I'll hearken back to that in summarizing just a few bits of data that you're undoubtedly aware of, but I'll bring together here. One is that in those consumption data, we know it's the top 10% of income earning households that are sustaining about 50% of consumption right now, growth in consumption, I should say. So, that K-shaped you mentioned is playing out, again, as Abby noted, with stagnation on the bottom leg rather than a downward sloping arm. But most of the top line consumption number is being sustained by relatively wealthy households. In the bottom half of the distribution, we are seeing debt grow slightly more quickly than incomes are growing. And that's being borne out in some of those rising credit numbers and delinquencies that go along with it. So, I would be reluctant to say we are on the precipice of a crisis, but when you think about the very nice framing Abby gave us of a world where the left-hand tail of the distribution is much fatter right now than the right-hand tail, and markets are already priced for perfection, we've got more data going into substantiating that left-hand tail at the moment on the issues you're raising than we have to the rosier right-hand tail. So it's making harder and harder to sustain that price for perfection that we see in equities. Please, far back.
It's interesting to me that the questions are normally in the front of the room.
True.
And we're seeing so many more hands up in the back, so that's great.
Hi, how's it going? Thanks for your time today. My name's Ford Thompson, first year MBA student. I was wondering if you could talk a little bit about the US federal deficit. And first, so what kind of path forward do you see in Washington to potentially balancing the budget? And then also for investors and consumers of the US dollar, how should we think about protecting ourselves from higher inflation in a world where we move away from the dollar as the global reserve currency?
Mm-hmm. Yeah, so wonderful question that relates to a problem that's been out there for years, which is the United States has a very large budget deficit. The last time we had a budget surplus was under Mr. Clinton, and it only lasted a few years, obviously. The thing that's disturbing to me about the current budget deficit, because we almost always have one, but what's disturbing about the current one is that it's growing even though the economy is growing. Normally, when the economy is growing and there are tax revenues increasing, both on the individual side and also on the corporate side, we tend to see that it declines. We've not seen that. The way I prefer to look at it is the deficit as a percentage of GDP, which is also not declining. By the way, you look at it as a percentage of GDP because that is a measure of how much can we afford. And we're just not moving in the right direction. And I am concerned about it. The omnibus bill that was passed at the beginning of 2025 by the Congress had many aspects of it which made this far worse. Now, there are some things that are pretty good that are in there for corporations. The fact that the depreciation schedule has changed, that's going to, all other things being equal, push up the corporate reported profits this year. But there were a number of things in that omnibus bill that are making the deficit much worse right now. And what does that mean in terms of the standing of the United States and the US dollar? We remain quite dependent upon demand for our Treasury securities from outside the United States. As long as you're the reserve currency, note comments from 20 minutes ago, as long as you are the reserve currency, that's fine. And by the way, looking at some of the weekly and monthly data that are available with regard to this, we're still seeing that there is demand for our securities, our Treasury securities, but there is no long-term guarantee that that will be the case. So I think we need to, as a nation, think about where we're actually spending the money, because the other thing I'd like you to contemplate, it's not just the size of the deficit or the size of the deficit relative to GDP, it's what are you doing with the money? We have run large deficits as a percentage of GDP, not necessarily this big, but as a percentage of GDP, and it's worked out really well because we've used it to invest in ourselves. For example, investing in education, investing in science and technology, investing in things that would give us significant long-term economic growth. What has happened, however, over the last year or so is that we're actually shrinking our commitment to this long-term investment. So there has been a shifting that the spending and the increased level of deficit isn't going for things that would give us long-term economic growth, but rather short-term gratification. And that's not the way for an economy to succeed on a long-term basis.
Well, it's a mark of a great conversation that time has flown, and we do respect our schedule here at CBS and the fact that you have other things in your calendar. The kind of conversation we've had today is the conversation we have across our economics courses here. And I want to mention, in a rare moment for economics, there is a free lunch today. And you can pick up that lunch by exchanging your sticker for a lunchbox in the alumni suite just behind the room here. Before we leave, I would like you to join me in thanking Abby for sharing her perspective and wisdom today.
Thank you.
Thank you for being here. Thank you, Abby. And watch the calendar for more Chasen events this term.